Hello and welcome to the investment review for March 2014, where we'll be taking a look back at recent events and also casting our eye slightly further forward. We give consideration all of the time to the returns from different type of asset classes, and broadly speaking, our considerations take into account the returns that we can get on equities versus the traditionally safer returns that we can get on bonds. While 2013 was a strong year for global equity markets, the opposite can be said of the bond markets, which experienced its worst year since 1994, with total returns on 10 and 30-year government bonds at a 20-year low. Overall, commodity markets also experienced a fall for the third consecutive year. In turning our attention to 2014 and beyond, what we can see is that the global economic recovery is expected to continue in 2014 with stronger GDP growth in the US, UK and Eurozone than in 2013 and only slightly lower growth in China and Japan. It's the developed economies that will continue to lead global economic growth, with emerging markets remaining reliant on exporting raw materials and finished goods to the developed world. The growth in emerging markets is therefore likely to continue to remain constrained by developed world growth. Recent events in the Ukraine are unfolding, therefore we need to reserve a place for meaningful comment in the next review. With regard to investment returns, the 59th edition of the Equity Gilt Study from Barclays Capital was published in February. It incorporates UK investment data going back to 1899 and US data from 1925, and is used by investment analysts, financial journalists and fund marketing departments to provide statistics about long-term equity investments. The real returns, i.e. those net of inflation, to the end of 2013 are shown on the next slide. The results clearly show that in all periods the return from UK equities has outstripped those from UK gilts. Worldwide equities were the best performing assets of 2013, producing a real return of approximately 29% overall, despite a fairly turbulent ride. 5 years ago this week, on the 5th of March 2009, the Bank of England took the dramatic effect of cutting interest rates to their lowest level in more than 300 years, and it's not clear when rates are likely to increase in the immediate future. Those with mortgages have reaped the benefits of the low rates, but it's the savers that have suffered. The real return on cash has been in negative territory for several years, and inflation has eroded its purchasing power, so money has been losing value in real terms. In the example on the next slide, with inflation in the UK at, say, around 2%, a basic rate taxpayer needs to be earning 2.5% and a higher rate taxpayer 3.34% in order to simply maintain the real value of their savings. Taxpayers are also subject to income tax on their savings accounts. The equivalent gross savings rate needed to equal the rate of inflation. For investors who are willing to take a measured risk on their investments, a carefully selected portfolio of investment instruments can be selected to try to help beat the effects of inflation on savings whilst aiming to generate a modest return. The graph on the next slide demonstrates the return over the past year, which shows that there was some volatility in our moderate risk portfolios, which we number 3, 4 and 5, but overall the returns did beat inflation. Please do give us a call and talk to us if you're thinking that it's time to take some risk, albeit measured and thought out, with some cash savings. Here's the graph referred to in the earlier slide, showing how there has been volatility, but with a degree of measure and balance inside portfolios, we've managed to move money forward ahead of the rate of inflation. So the end of the tax year fast approaches. It falls on the same day every year, the 5th of April, but of course we feel duty bound to remind you of certain allowances that may fall into the use it or lose it bin. Thinking about ISAs, if you've not made your ISA investment for the current tax year, please contact us as soon as possible to arrange this for you. £11,520 is the maximum allowance for 2013-14 tax year. Pension contributions can be an effective way of helping to mitigate tax liabilities. Next year, the maximum individual pension contribution reduces from £50,000 to £40,000, but it is possible to carry forward up to 3 years of unused pension contribution allowance. And therefore, if you have a potentially large tax bill arising in this tax year, it may be possible to reduce the tax you pay by making a pension contribution. Please contact us for details of the rules and to discuss whether or not you qualify for this very valuable tax relief. It's important that we remind everybody with children that child benefit is clawed back where annual taxable income exceeds £50,000. So pension contributions could be considered as a way to reduce your income below this threshold for the purposes of child benefit calculations. The capital gains tax allowance is one that you either use or lose every year. Realising gains from your qualifying investments each year up to the allowance of £10,900 in the tax year 2013-14 is a way of receiving tax-free income. If appropriate, gains could be reinvested into your ISA or even into your pension fund as a contribution. Please do contact us to discuss your circumstances and whether this may work for you if you think it's appropriate. So bringing this review to a close, in summary, as always, please do feel free to contact us if you have any questions or would simply like to review your existing arrangements. We don't believe it's appropriate to make any immediate changes to our portfolios, but please be assured that we continue to monitor the markets, and of course we would contact you immediately if we deemed it necessary. All of our contact details appear on the next slide. Thank you for listening.